Hello, my name is Chris Walker, and welcome to Freedom One's next installment of the 8-Minute Update on our continuing theme of Protect, Prepare, Recover. This update's topic is the stock market's up 37%. What's Freedom One doing next to protect your portfolio? I'm joined today by Jenn Client Relationship Manager here at Freedom One.
Hi, Chris. It's great to be here today, and this is really a question I'm hearing a lot when we're out on the street meeting with participants and plan sponsors.
Well, Jenn, let's start with the pain that we've had the last year and a half. As we're all aware, the stock market's been down a massive 57%. It was certainly painful for all of us. The economy has slowed down. People have lost jobs. It's been very, very difficult the last year and a half. What we're hoping to do is to be able to show signs that things are turning around or at least stabilizing.
Things have been really tough out there. We've been talking to participants who are struggling with having family members out of work and just trying to keep the ends together. So whatever you can give us is really going to help.
Well, as you may recall, 3 updates ago, we talked about signs of recovery, where we saw some things in the economy that looked like they might be turning around. We weren't the only one to notice that. The stock market actually, over the last 9 weeks, up an amazing 37%. That's a very impressive return for a short-term period of time. What we're hoping is that our portfolios, and what we want to report on today, is how our portfolios have responded to that.
That's great, but I know that our portfolios don't just have stocks. And while the stock market is up 37%, what does that mean for the rest of our portfolios?
Well, that's a good question. Not only is the stock market up 37%, but if you remember, January and February were pretty poor months in the stock market. They were down almost that amount. So the stock market year to date is pretty much flat. And I'm real pleased to say that not only our stock funds, but also our bond funds have done well. So in an environment where the stock market's been flat, 2 of our best performing funds have the T. Rowe Price New Horizons Fund. It's a stock fund, and that's up 12%, as well as our Dodge & Cox International Fund. Now, that's up almost 14%, which is just an amazing return for that short period of time in a very difficult market. Now, Jenn, as you mentioned, we don't own just stocks. We also own bonds in the portfolio. 2 of the bond funds we have, one is Dodge & Cox Income Fund, is up 4.6%. And if you recall, I think it was in our second update, we talked about Loomis Sales, some of the concerns that we had on Loomis Sales Bond Fund, and we elected to hold on to it. Well, that's up at 10% so far this year. So I'm very pleased with the way that's performed.
That's really great news, and it shows that patience does pay off.
It does, and I'm very proud of what's happened. And you know what? I'm equally proud of the way that our Freedom One maps have performed thus far this year. It may come as a surprise to a lot of people, but actually they've made money in every one of our portfolios this year. We're up a little over 1% in all the different portfolios. And for the last 3 months, our portfolios have performed in line with the markets. And you can see here the aggressive map is up over 7%, all the way down to our income map, which is up almost 2.5%. So I'm very pleased and very, very proud to announce that we've had some nice performance going on.
That's really great news. I was actually with a plan sponsor last week who was surprised that he had made money year to date. And so I think we just crowed that right to the top of the building.
Yeah, it is difficult because all you hear about on the news is how terrible the markets are and how terrible the economy is. So I'm very pleased that our first phase, the protect phase of what we've put in place here at Freedom One, has actually been paying off. And surprisingly, we are up for the year.
So does that mean we're going to do something different, or what's next?
What's next is, well, first let's talk a little bit, before we talk about what's next, let's talk about what got us here. As you recall, a few weeks ago, we talked about that there were signs of recovery, and those are continuing. Manufacturers are starting to get new orders. Now, they're still not working as hard as they'd like to be. Manufacturers are still being underutilized, but they are getting new orders, and that's impressive. That wasn't happening 4 and 5 months ago. Unemployment claims, and that's new people being unemployed, is actually slowing down. It's not as aggressive as it was in January and February. And housing inventories, now those are decreasing. Now that may be as a result of foreclosures or short sales, but still there are less homes on the markets right now.
You're saying signs of recovery, so I guess that means there's still some more to come?
Absolutely. There's a number of things we're concerned about. As we've talked about in the past, what we do is we follow these leading capital indicators. And as we just talked about, some of them are doing well, but others are still doing very poorly. So some continued signs of concern we have one of them is slow consumer lending. What we mean by that is that consumers aren't spending money right now. Actually, for the first time in almost a decade, consumers earned more money than they spent. The consumer savings was actually at 4% for the last period of time. That just means that consumers are becoming more cautious and more prudent. On an individual basis, that's great. But the problem is when everyone does it at the same time, that slows down the economy. So slow consumer lending is becoming a problem. Unemployment rates, now, as we mentioned, unemployment, current people becoming unemployed is slowing down. But unfortunately, there aren't jobs for the people already unemployed. So the unemployment rate is going up, even though the amount of new people being unemployed is slowing down. And finally, the one that all of us have felt, or a lot of us have, is negative homeowner equity. What I mean by that is that when the mortgage of your home is greater than the market value of the portfolio, and that obviously has a negative implication on people. They just don't feel as good when they have negative equity in their home.
Yes, I'm actually in the same place. So what do we do next?
Well, what we do next is stay doing exactly what we're doing right now, and that is that we stay in this protect phase. Even though the market is up and our portfolios have been, very fortunately, have gone up with them, we just don't see things that are sustainable right now. We want to stay in this protect mode. It served us very well through the first 4 months of the year, and I think it'll continue to serve us well until we start to get more confidence. Now, what we're doing in the protect mode is that we have lower than average stock allocation. For example, you can see here in our aggressive portfolio, which normally you would see an awful lot of stocks in, we only have 65% in stocks, all the way down to our income investor with only 15% in stocks and the remainder in bonds. And with the stock funds that we're buying, we're seeking funds that have higher quality securities in those funds.
That's great. I am getting a lot of people calling me, though, that's asking, should I change my portfolio?
Well, maybe they should. What I think each one of us have to do is to take the investor quiz, and take that honestly to see if and don't take that and don't answer them because the guy next to you answered one way and you feel you should answer the same way. Answer individually and sincerely the way that you feel your risk tolerance is, and that'll be a great guide to what the appropriate map is.
You know, that's really something I like to tell plan participants, too. They'll often ask me, which one's the best? And I tell them, the best one is the one that's right for your personal risk tolerance. And they should know that they can call client services and get that risk tolerance assessment. And they can also talk to an RC or give their client's relationship manager a call, too.
Absolutely. And we encourage everyone to do that. Even if you've just done it a few months ago, your personal circumstances may have changed, and it might be important for you to reevaluate that. We are not going to move into the next stage of our phase 2 into our recovery stage until we feel that the economy is a little more stable. What we need to do is to see that there's increased bank lending, improved capacity utilization, which gets back to whether how hard factories are working, and finally when we start to see our housing values stabilize a little bit. We're all concerned about the way that's working. Hopefully what then happens is when we see these sustainable signs of recovery, we'll be able to move into step 2, our recover mode. And at that point, what we'll do is we'll increase our stock allocation and increase our exposure into other asset classes, such as small cap stocks or more into international. And
when you say we, that means Freedom One. Participants aren't going to have to do anything. That's going to happen automatically for them, right? Absolutely. Great point. No, it's that's what you're hiring Freedom One to do, is that we make those decisions and implement them when we feel it's appropriate. If I could, our next 8-minute update is going to be on June 4th. We'd really like to know your thoughts about what you think about the 8-minute updates. If you'd please do us a favor and take our survey at the end to not only give us feedback on whether these 8-minute updates are meeting your needs, but also if you have any new topic ideas. And once again, I appreciate the fact that Jenn is here and look forward to having her on future updates. Thanks, Chris. It's been great.